Good congestion pricing morning, 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Now coming up, shareholders revolt. 2024 was a stellar year for corporate activists. We're going to break down the latest numbers with Jim Rossman, Barclays Global Head of Shareholder Advisory.
And the steel deal that just won't die. Nippon Steel and U.S. Steel file lawsuits in a last-ditch effort to preserve a deal. We'll have the latest.
And Chuck E. Cheese, the iconic 80s mouse you love to hate, expanding its entertainment restaurant chain. We'll speak to the company's CEO next hour. All of that and more coming up. Let's take a look at where markets are trading. That momentum we saw on Friday continuing on, at least for right now. The S&P 500 up by about 0.9% in the pre-market, being led in a big way by big tech. You can see the Nasdaq 100 higher by more than 1%. Despite what's going on in the bond market. Of course, we're unchanged right now when it comes to the 10-year Treasury yield, but we're talking about 4.6%. That's close to the highest levels since May or so. A lot of sell-side research out this morning talking about the possibility of what that means for risk appetite in the equity market. Matt Miller, are you scared?
Yeah, that could be dangerous for stocks. But our first guest this morning says the most important rate to watch is the unemployment rate. Of course, we're going to get the final reading of that for 2024. I have behind me the non-farm payrolls report that comes out at the same time on Friday. And we're looking at a lower peak than we saw throughout the rest of the year. Still 160,000, so better than a stick in the eye. But could it be a downturn for stocks?
Not yet too much fear from me or the market, certainly not from you, Matt. We're taking a look also at some individual movers because you are seeing that optimism back. Chip stocks like Micron are surging today. Traders are piling back into that AI trade after the year-end sell-off. Fubo absolutely soaring this morning after Bloomberg reported that the streaming provider and Walt Disney are nearing a deal to combine their online live TV businesses. Fubo is just on a tear, up about 200% nearly this morning, about 190%, that Magic Kingdom boost. Finally, the steel deal you're talking about, Nippon and U.S. Steel jointly filed lawsuits against the White House's decision to block the merger. U.S. Steel now up 4.4% this market. Of course, we saw downdrafts last week after we saw Biden officially shutting that deal down. And of course, the president-elect coming out on Truth Social this morning saying that they should be independent. They should just wait for those tariffs to save them, Matt.
All right, there's a lot to talk about in terms of single stock stories today. We're going to cover all of those, but the top of my mind really is the congestion charge. It's the first day. It's a new era for New York City, right?
How was your commute in?
So I have always said, if the congestion charge is big enough, I will take a train instead of driving. Because the idea is you want to drive behavior. You want to change people that are, one person in a big car with a 6-liter V8, driving in and out every day is not good for the environment. But it's $9.
Yeah, where I fall on
I drove.
You drove. Where I fall on it, of course, I live, in Manhattan, so it doesn't really affect me. But where the money actually goes to and how it's spent, of course, it's supposed to be spent electrifying buses, I believe, and improving the subway. That all sounds good. I'm really curious to see if that actually happens.
It also falls below 60th Street is where you have that pricing cut in. So what happens to pricing above that for things like parking garages, for other types of amenities?
But by the way, you drove as well, right?
I did.
So
and
$9 wasn't enough to sway me or you.
But did you know it's phasing into $15 over time?
Yeah, it's brutal. The biggest question I have, of course, is how does congestion pricing affect the 10-year Treasury?
Okay, this morning, we got Morgan Stanley saying that these rates are the most important thing to watch.
His name, Mike Wilson.
Mike Wilson for stocks. However, Stuart Kaiser said no. It is not the 10-year Treasury rate that's the most important thing to watch for the direction and leadership of stocks. Rather, it is the unemployment rate. And he is Citi's head of equity trading strategy. He joins us here at the desk. Stu, I guess this is a debate the Fed is having as well, right? Is it labor or is it inflation? And you're looking right now, you favor the labor picture as the sort of canary in the coal mine.
Yeah, 100%. I think the Fed is clearly more focused on the growth side of their mandate than they are on the inflation side, and they specifically called out the unemployment rate as kind of the key thing they're watching. So to us, the unemployment rate is the most important kind of macro data point you're going to get each month. And look, the bottom line is the 10-year yield is a price, right? And that price reflects the data. So if you're getting a higher 10-year yield from here, I think what that's telling you is U.S. growth is strong and positive, and that's net good for equities. The fact is, to get the 10-year rate significantly lower, I think what you need is weaker U.S. growth. And if you're a U.S. equity investor, you should not be hoping for weaker growth. You should be hoping for stronger growth.
There's two interesting points in there, both that you're so focused on the unemployment rate and not inflation, since we talked to a lot of inflation worry reports, but also that you say the direction and leadership of stocks. Explain what you mean by that.
Yeah, look, I think, to my point, if you get higher yields, I think that's coming from a positive growth picture. That's good for equities higher. And if you're getting a positive growth impulse, that's the type of thing that's going to get your small cap and your cyclicals working and kind of catching up a little bit. So I think a strong unemployment rate, higher or lower unemployment rate, higher yields, I think that's a pro-cyclical trade. It's equities higher. It's a little bit of a catch-up of some of the laggards we've seen.
But when you think about growth, why do you think that that's kind of the main driver here? Because ultimately, you're seeing that fiscal term premium really be baked into the 10-year. Doesn't that start to complicate the equation moving forward?
I mean, look, the reason we're focused on the unemployment rate is because the Fed is, right? So if that is how the Fed is making their decision, then that's what we're going to focus on the most closely. I think when you're talking about bond term premium, I'd be much more worried about that at the longer end of the curve, like out at the 30-year point. And the logic there is pretty simple. If the 10-year yield, let's say, got to 5.5, I could paint for you a good reason why that could happen. If the 30-year yield, let's say, gets to 5.5, it's very hard to come up with a good reason why that yield is moving. So I think if you get bond term premium steepening, particularly at the long end, that's telling you, deficits and fiscal spending and tariffs are really starting to impact the market. And yes, that would worry us. So we are concerned about the bond term premium, but a little bit more at the longer end of the curve than at the belly.
I'm looking at the loonie right now. You can buy 1.42 for the dollar. That continues to drop as we get headlines across that Justin Trudeau is going to step down as the leader of the Liberal Party. And of course, then that would mean that he steps down as PM. And it's a fascinating story that we sort of have gotten telegraphed throughout the last 24 hours. This started when Chrystia Freeland, really kicked off when Chrystia Freeland wrote a scathing resignation letter. But for those of you watching Canada, I imagine you're watching the U.S. dollar, Canadian loonie first and foremost. And as you can see, that continues to fall as we get these headlines.
A lot of this has to do with what has happened in really recent days. You have Canada reacting to the president-elect policies here, and that impacting their own political situation. We're watching the dollar as well. How do you take into account that rise in the dollar relative to world currencies and how you make your decisions about U.S. equities?
Yeah, generally probably a little bit less concerned with the dollar than some other folks are. I mean, I think really to impact equities via the dollar, you need the dollar to move significantly and to stay high. Because a lot of the corporates kind of hedge their FX risk for a few quarters out anyway. So I think it does matter from a kind of a risk premium perspective. Like, is the dollar strong because people are trying to hide its safety? So in that sense, it matters. If it's kind of moving on these other factors, probably a little bit less concerned.
There's so many reasons why the dollar is strong, right? You get Trump tariffs coming in. You've got the Fed cutting less than anticipated. I guess a safe haven play could be one of those issues, but it wouldn't be the first that I would think of. Is it for you?
Look, I think if the dollar's strong because of quote unquote U.S. exceptionalism and there's a large demand for U.S. dollar-based assets, I think that's net positive for equities. If the dollar is stronger because you just have a risk off, I need to kind of turtle up and hide under the table for a bit of time, that's kind of less positive. But I think what we're seeing from foreign demand for U.S. equities, from large ETF flows, things of that nature, is people are buying the dollar and buying U.S. assets not because they're concerned about growth, but because of a scarcity premium of large cap tech stocks globally, which is what we happen to have.
Well, I also think those yield differentials are so powerful right now.
Good point.
You think about 10-year yields up 100 basis points since the Fed cut rates, began that cutting cycle. It doesn't quite make sense, but let's talk about earnings because we have maybe a little bit more clarity or some clear expectations for what's going to happen there. You think about the Magnificent Seven alone. They're expected to have a combined profit increase of 18%. That's down from 34%. I mean, when you think about leadership in this market outside of what the unemployment rate dictates, what does that potentially mean?
Look, I think it's all a relative story, right? So yes, the growth rate on Mag 7 is lower than it was last year, but it's still significantly higher, than the rest of the S&P 500, for instance. Consensus is EPS on the S&P is going to grow about 15%. I think in Mag 7 it's 18 to 20%, which by definition tells you the SPX 393 is going to grow earnings less than that. I think probably more importantly for a lot of investors, European earnings growth is only about 5%. So essentially what you're telling me is, yes, the earnings growth rate on Mag 7 is decelerating, but it's still superior to the rest of the S&P 500, which itself is far superior to the rest of the world. And I think what that tells us is there's still going to be a lot of demand to own these large cap tech stocks.
Well, beyond earnings, what are going to be the catalysts that really drive investors into certain equities and maybe sectors outside of AI? Is it going to be buybacks? Is it going to be other forms of capital return? Is it still the AI story? If you see it even outside of NVIDIA, do you need companies to mention that more and more, even if they are not a technology company?
Look, I think AI is obviously still a very powerful investment theme, particularly on the power generation side and on that CapEx side. Microsoft last week announcing $80 billion specifically on data center CapEx. That's clearly still important. The NVIDIA chip was running a little hotter than expected. And by hot, I mean, the heat it actually gives off in a data center. I think that is also reads positive. So we do still like that power gen theme. If you're going to broaden out beyond tech, I think what you need to see is what we saw in third quarter earnings and second quarter earnings, which was actually a broadening out of EPS growth, where that SPX 493 is generating positive EPS growth and getting people confident enough to move, kind of down that cap structure, which frankly we thought was going to happen early last year. It didn't happen until the middle of the year, and I think that is, very much reliant on that earnings growth picture.
All right, Stuart, it's great to see you as always.
Thank you.
Happy New Year. That is Stuart Kaiser of Citigroup joining us on the set, and to really interesting, of course, start to 2025. You think about how choppy this trade has been.
Super choppy, and a lot of activity happening on the single stock level. The reason I was asking about what the companies can do is you look at Uber, for example, that accelerated share buyback program pushing the stock up 4% or higher. This morning, they're front-running earnings, right? Which is good news for investors.
So many transportation-related stories.
Do you want to talk about Lucid? Because we've got some delivery numbers out.
I'm shocked at they're very small. They're very small, but no, 3,099 vehicles are delivered in the fourth quarter for Lucid. That's an incredibly small number.
It's good for Lucid, though.
But it's much better than had been anticipated, right? We were looking for 2,339, so they beat that number by almost 700 vehicles.
Yeah, I mean, with all of these names, it's about the direction of travel and expectations, right? Because you think about Rivian, also, of course, a magnitude more than Lucid, but still, it's all a drop in the bucket compared to Tesla.
But they also had a big gain. So
yeah, a surprise. But when you compare it to Tesla's 500,000 roughly, it's a hard comparison to make.
Right, or the 10 to 12 million that you get at a real automaker. Coming up, we're going to have results from the latest Bloomberg MLive survey of traders and economists. The topic, as Stuart mentioned already, U.S. exceptionalism. We'll break down the results next, and we'll tell you what's ahead for Canada after CBC says Justin Trudeau is stepping down. This is Bloomberg. Let's get now to high interest, a look at what's making headlines around the world. Canadian Prime Minister Justin Trudeau is expected to announce his resignation as leader of the Liberal Party in the next hour in Ottawa at 10:45 a.m. New York time. That's according to the CBC, Canadian Broadcasting Corporation. Trudeau has been under pressure from lawmakers in his party to quit for months. Calls for his resignation intensified after Chrystia Freeland, his finance minister, stepped down and wrote a scathing resignation letter last month. Now, the Washington Post is reporting that President-elect Donald Trump's team is exploring universal tariffs that aren't really that universal. They would still be covering every country, but only a certain number of products that are critical to the U.S. economy. The policy would mark a more conservative shift than the broader 10 to 20% universal tariffs that Trump proposed to put on all products in all countries during the campaign. The dollar fell against most major currencies on that report. And in New York City, congestion pricing has taken effect as of last night after a judge ruled against New Jersey's request to stop the program. Taking the lead from London, Stockholm, and others, the policy is the first of its kind in the United States. but it's much cheaper than it is in other countries. Drivers entering parts of Manhattan will be charged $9 during peak hours. The initiative promises to deliver $15 billion in revenue to the Metropolitan Transportation Authority, which runs the New York subway system. Sonali?
And I also want to mention that the president-elect has responded to the Washington Post story that we've been talking about all morning here. Of course, this idea of universal tariffs. Trump is saying on Truth Social that the story on critical imports on universal tariffs was incorrect. So he's pushing back quite meaningfully here and flatly calls the story incorrect. We will talk more about it, look into it more as we go along. Of course, a lot of posturing going on in Washington and a big day in Washington as we know it. But we're going to move on. We're going to talk about what Trump's tariffs really mean for markets. We're going to take a look right now at the strength of the U.S. dollar. There's been a U.S. dollar index against major world currencies rising by more than 7.5% since its September lows. And the dollar has mostly held on to its strong rally since President-elect Trump won the 2024 election. According to the latest Bloomberg Markets Live Pulse survey, the dollar might still be one of the biggest beneficiaries of Trump's policies. Joining us now, Bloomberg's Christina Aquino. You know, you look at this run-up, we've already had one. So why do investors still believe there's more room to run in the dollar as we see these tariff policies come to light, especially if some of them might be even lighter than the initial campaign promises?
Yeah, well, interestingly, Sonali, I think there's this really notion that the dollar is going to be supported by more than just those tariff policies, right? There is this broad expectation that President Trump will come in and that will just be overwhelmingly positive for growth. That really is what our survey participants were really harping on, this expectation that growth in the U.S. will be much stronger and, importantly, much stronger than the U.S., other U.S. peers. And that's why that's important. Right. It's the relative strength of the dollar that they all believe will really carry the currency through, or at least 51% of our survey participants believe that much anyway.
So that was one leg of the survey. Talk to us about what the survey respondents said about when it comes to the S&P 500. Of course, you have the Wall Street sell-side community finally throwing in the towel on bearishness, expecting about a 10% rise in the S&P 500. What did you learn?
Well, Katie, I think it is also just as positive. We did see 61% of our respondents saying as much. They expect stocks to continue gaining, again, because of the story of U.S. exceptionalism, right? And a lot of that, I think, from the stock side of things, really being driven by optimism over the tech story. I mean, even if there are skeptics over there over whether the AI story will continue into 2025 and will keep propelling stocks, the reality is there really is not much of an alternative out there when it comes to the U.S. tech sector in particular, and really more broadly, the returns that you could get from the U.S. stock market versus other markets in the world.
We have most people saying any Treasury yield above 450 on the 10-year is the danger zone, right? Some people are saying 5% is when you really need to worry. What did the respondents in your survey say about high rates and the continue of the stock rally?
Well, Matt, I think there is an overwhelming expectation for Treasury yields to keep powering higher, especially into the beginning of 2025. And I think a lot of that is a combination of what we're seeing again with the growth story that comes hand in hand with higher yields, but then also how the Federal Reserve plays into this equation, right? I mean, we did see the Fed officials at their last meeting last year really scaling back those expectations for how much they can deliver in terms of rate cuts this year. Markets are even pricing fewer than that. I think they're pricing, last time I looked, fully pricing just one rate cut and just a little bit more probability for a second one. So a second one is not even fully priced, even if that is the Fed's central scenario. And so that really just speaks to a recipe for higher yields into 2025 for sure.
Christine, what else are you looking out for into this year? Of course, there's a multitude of questions to be looking out for with this market as we stand near record highs still on the S&P 500. What are the critical questions you're asking of investors right now from Markets Live?
Yeah, I mean, I think it really is that kind of interplay between these critical levels that we're seeing across a number of markets, right? I mean, I think Matt was alluding to this point that the Treasury yields at a certain level would be considered the danger zone just because, you know, the comparative appeal of stocks starts to diminish really once you get yields that high. And the reality is, even though the returns that you could get from Treasuries probably not really comparable all that much to stocks, investors would still prefer to hold them as a part of their portfolios, right? And so there is a kind of trade-off that you would get with yields at certain levels. And I think the dollar stocks interplay as well, especially if we're heading into earnings season, a strong dollar reflective of a strong U.S. economy. But at some point, that will start to bite, especially for countries or for companies that are exporting their goods overseas, right? That really diminishes the appeal of their goods. So I'd be interested to see actually how much of the currency will get mentioned in earnings report this season.
All right, Christine, really interesting stuff. Really appreciate you taking the time. That is Bloomberg's Christine Aquino. She heads up our Markets Live blog. Let's take a check on these markets. Of course, we had some interesting headlines coming from President-elect Donald Trump on Truth Social, basically denying that Washington Post report that he's considering universal tariffs, but on critical imports. Of course, Trump's coming out and saying that story was incorrect. You see the markets right now. You can see the S&P 500. It did react a little bit, of course, taking a bit of a dive, but still firmly in the green right now. The S&P 500 up about 0.6%. Big tech, a little bit better than that. The Russell 2000, this is interesting. This had been your pre-market leader, of course, that small cap index. Now it's just middle of the pack here, of course, up about 0.5%. You train your eyes on what's going on across asset right now. You can see 10-year Treasury yields did rise a little bit on that tweet or post on Truth Social from Donald Trump, and the dollar, too, reacting as well.
Yeah, we do see the dollar moving on that, and you saw the dollar come down on the Post story as well. So it would make sense that when Trump says the Post story is incorrect, and he says his tariff policy will not be pared back, that you see a reversal in that dollar move. This is the DXY. I prefer the Bloomberg dollar index. Yeah, BBDXY. It's a broader basket of currencies.
Yes.
In any case, either way, you see the move up. Coming up next hour, we discuss the sectors poised to benefit the most from an incoming Trump administration with Nancy Tengler. That's at 10 a.m. This is Bloomberg. All right, we're still looking at a second day of gains, potentially even after Donald Trump reassured markets he means universal tariffs on all goods and all countries. We see futures rising 0.7% on the S&P, NASDAQ futures rising 1%, and tech stocks really powered the big rally that we saw on Friday, bringing us up to 59.42 at the closing level. You hear the opening bells on this Monday morning. Down at the NASDAQ market site, you have Headspace, and I'm told it's a great app for mindfulness. That's something that I desperately need. JBT Marel ringing the bell at the New York Stock Exchange. We're going to talk to the CEO and president of JBT Marel in less than an hour, so stay tuned for that C-suite interview. In terms of the major averages, as I said, Katie, we had a rally on Friday, and it looks like we're set to gain again today, at least at the open. What do you see on the averages?
Exactly. Quite a lift to start this week. The S&P 500 higher by about 0.7% right now. Big tech is your leader. If you take a walk among the sell-side research, there's a lot of concern about decelerating earnings growth when it comes to the Magnificent Seven. You're not seeing that today. The NASDAQ 100 higher by about 1%. Small caps also catching a bit here to a lesser degree, though. You can see the Russell 2000 currently higher by about 0.4%. This had been your pre-market leader. Not the case right now. Let's take a look under the hood, though, and we'll take an eye on NVIDIA, AMD, and Micron, of course, keeping a focus on these chip stocks rebounding. That's after they hit correction territory at the end of the year. Now, some of this bullishness may come from Foxconn's report today of faster than expected revenue growth, but you take a look at some of these numbers. You take a look particularly at NVIDIA up 2.7%, helps explain why tech, of course, in the driver's seat this morning.
Yeah, super interesting ahead of Jensen Huang's speech this afternoon over at the Consumer Electronics Conference. Also taking an eye at some Magic Kingdom love. Fubo absolutely soaring this morning after Bloomberg reported that the streaming provider and Walt Disney are nearing a deal to combine their online live TV businesses. Fubo is up about 155% at the market open, Matt.
Yeah, it makes sense. Fubo is tiny, Disney is gigantic, and when a giant comes in and buys a tiny stock, they usually pay a premium. Nippon and U.S. Steel jointly filed lawsuits against the U.S. over President Biden's decision to block their $14 billion takeover proposal. The companies say they are confident in delivering a deal at $55 a share. The market, not so much. The shares are up in the live trade, but only 4% to 31.77. So, I mean, as you get a president coming in who ran on America first, is he really going to sell off the steel business of the United States to a foreign entity?
It doesn't seem like he would. I thought this was interesting, though, and this is the story that keeps on giving. You take a look at the statement that both of these companies put out. They said that the U.S. Court of Appeals for the D.C. Circuit, they say that CFIUS has failed to consider this deal on national security grounds.
Yeah.
We were talking about this last week, that national security grounds is a really broad church, and here it seems like both of these companies seeking a definition.
And
here.
CFIUS at least used to be the altar at which these things were really hashed out. If CFIUS couldn't really agree on whether this was or wasn't a national security issue, then it does mean the president of the United States might have more and more say moving forward.
I mean,
on
it's
what
a
is and what
steel
isn't.
manufacturer, right? What do you need in case of a war?
But you know,
Steel, right?
The other thing,
what if you're fighting against Japan?
The other thing, well, they're coming closer together, but that's besides the point. The other part about this deal that's interesting is that the president-elect made this on the grounds of potential future profits for U.S. Steel with tariff strategy. I know we're going to be talking more about that this hour, guys.
All right, let's broaden out here and discuss these markets with Ritholtz Wealth Management Chief Market Strategist Callie joining us on set. I'm pleased to say, great to see you in person.
Yeah, it's great to be here, ready to talk about the new year ahead.
All right, well, let's go. I was looking through your notes, and of course, we're talking a lot about the biggest risks. Some people say, of course, it's the unemployment rate potentially ticking higher. Others, such as Mike Wilson, say it's 10-year yields going higher. You say, though, the biggest risk, though, is missing out here.
Yeah, well, I'll clarify that. So it's high expectations, I think. And I do think that there's an element of, you know, if you do underestimate where the economy is, then yeah, you probably will miss out on another decent year for the stock market. But things are moving quickly, Katie. Obviously, we're seeing a lot of speculation around policy, which you just spoke about. We're seeing a lot of speculation around inflation, and if inflation is stalling out. There seems to be a lot of excitement about what's ahead. But if you think about the good years or the blowout years in the stock market, usually you see a lot of fear and skepticism followed by a pleasant surprise. And we're just not set up for that here, which is what we're reminding clients about.
There is fear, you know, in terms of valuations. They're high and frothy. There are people making comparisons to not only the internet bubble, but also to 2007. What's left to drive stocks higher if they're so expensive already and we're already all fully invested? Where does the impetus, the extra dollar come from?
Well, when I say high expectations, it really does. It's this broad assumption that, you know, valuations are quite high, but there could be value elsewhere if you're willing to look. I mean, tech has been the dominant story these past 2 years. So that's what we're reminding people to. Yes, there are high expectations. Valuations on a broader scale are high, but there is value underneath these markets, and conditions are changing quickly.
So the index level, you're saying high valuations, but if you delve in and look at individual stocks, you may make money?
Right. Individual sectors, individual styles. We've seen a lot of momentum and growth outperformance recently. Value and yield have been left behind. And I'm not saying that everything needs to catch up. Life isn't fair, you know. But if you're saying that valuations are high here and that you think that that's a deal breaker for the stock market, then I'd encourage you to look a little deeper.
You know, Stuart Kaiser over at Citigroup was taking a look at how those factors were performing, and to your point, value has lagged growth, but quality has been making a comeback. Quality is an interesting factor. How do you differentiate quality from value?
Well, quality obviously speaks to the financials, right? It speaks to the durability of the balance sheet, the durability of cash flows, and that makes a lot of sense. I mean, part of that has been that fear and skepticism has just really driven this bull market higher over the past 2 years. And if you talk about quality, you can throw big tech in there. That's some of the biggest, best quality companies on the market. But then you have to think about valuation, what really has driven the price higher. And we think that there are a lot of quality companies that still are being ignored.
Well, I'm glad you brought up tech, because that's where I was going to go. You asked the average investor, what's quality mean to you? A lot of people will say big tech. And let's talk a little bit about the earnings outlook for 2025, because it feels like some of these companies, they're macro agnostic. They're going to make money no matter what the 10-year Treasury yield is doing. But how are you thinking about the potential for a growth slowdown when it comes to that resplendent Magnificent Seven?
Well, we love big tech. We think that there are a lot of reasons to be excited about big tech companies. They've just gone a little too far here, and expectations are sky high. I said that at the beginning of last year. Obviously, tech had another wonderful year. But it is something to watch, especially when you're stressing portfolio balance, which is what we care about at Ritholtz. We have long-term investors with goals decades into the future. But we remind them that balance is important, right? You know, if big tech does well, you're holding big tech through our index funds. If big tech doesn't do well, then you're going to be happy that you focused on quality and value and, you know, anything outside of big tech. But you're right, the story is good. The expectations are still quite high.
Yeah, on Friday, I think Friday afternoon, Microsoft said they're going to spend an additional $80 billion on data centers.
That's a lot of billions.
That's compute power, and that's only for fiscal 2025, which isn't even through the end of the year, right? So I was looking at the story and thinking, who are they going to give those billions to? Obviously, NVIDIA is going to take a big chunk, but how much does AMD get? Is Broadcom getting any? What about Dell, you know, Cisco? Like, who is getting all this cash?
Yeah, and that brings up another thing, too. I mean, the AI trade is something that everybody's hearing about, and for good reason. And I think this year is the year of picks and shovels. It was last year as well. But the point you brought up, Matt, is, you know, all these, you know, big tech companies and AI leaders are thinking about how to, you know, implement these AI strategies in their workforce. It's not just hopes and dreams anymore. It's, you know, actual strategies. So I think as we see some concrete details come out from big tech companies, we can understand what the next phase of the trade is. You know, what semiconductor companies benefit, what software companies benefit. You know, kind of like thinking of the second derivative of the trade here.
Speaking of the second derivative, you look at the end of last year and you saw that catch-up trade that Broadcom had versus NVIDIA. And you also look at, for example, the S&P 500. You looked at energy companies, Vistra, rising at a rate that was faster than NVIDIA. It is hard to buy the argument that investors have bid up NVIDIA at the expense of some of the picks and shovels provider. Do some of those picks and shovels providers even look frothy to you?
I would say so. I mean, look at utilities, for example. Utilities thought of as a pretty boring sector, but they bring in the energy providers that benefit from the AI trade.
Vistra is trading at 55 times trailing earnings.
There you go.
Cheap.
Yeah.
Yeah, and I'll be honest here. I mean, luckily, you know, we're thinking long term, so we don't have to be stock pickers that blow the market out of the water every year. But it's an important example, and I think the right way to approach it, especially if you have that broader mandate, is to look across sectors, own everything, lean towards value because you know valuations are high, and hope for stable returns year after year.
Callie, thank you for coming in. Of course, that is Callie Cox of Ritholtz Wealth Management. She's the chief market strategist there. We're going to take a look at some movers under the market right now as well because Uber is still on the rise. It had announced a $1.5 billion accelerated buyback program. Interesting to see how investors are reacting to news like that. Let's see what the actual numbers say. Also, guys, watching Freddie Mac and Fannie Mae, because you may remember that last week you had the Treasury Department, you had the Federal Housing Finance Agency putting forward a roadmap on what a privatization of the two could look like. Remember, government control has been wrested since that 2008 financial crisis. Freddie and Fannie up 15% today. There's a lot of doubt. The Trump administration itself, a spokeswoman for the transition, said that no policy should be seen as official unless it comes directly from President Trump. But a lot of major investors, Bill Ackman including, having a lot of money on the line for a trade like that.
Yeah, absolutely fascinating story. Another one is what's going on in the hush money trial. Remember Donald Trump paid off a porn star to keep that story out of the news? Well, he was found guilty on 34 felony counts of falsifying business records to conceal those payments to that porn star. I think Stormy Daniels was her name. In any case, the former president, incoming president, has now asked New York appeals court to delay the sentencing in that porn payoff hearing. It's set for January 10th, which is Friday, but the president-elect is trying to have his guilty verdict tossed out as a result of his election victory.
All right, so a lot to keep an eye on there. Also keeping an eye on the stock market, the S&P 500 at session highs. We'll talk about all of that and more coming up. Also, Wall Street analysts turning bullish on American Air. We'll have the details in Top Calls next. This is Bloomberg. Welcome back to Open Interest. Let's take a check on the stock market at session highs right now. The S&P 500, we're back at 6,000. It was a rocky road for a couple of weeks there, but here we are, of course, at these session highs. You can see, of course, big tech is leading the gains today. NVIDIA up several percent, 3% or so. That is the biggest points contributor to both the S&P 500 and the NASDAQ 100. The Russell 2000 also higher, even without NVIDIA's influence. You can see the small caps index currently higher by 0.75%. It's time now for our top call. Some of the analyst action in focus this morning. And first up, we have Barclays upgrading Boeing to a buy as the analyst turns positive on the stock for the first time since 2019. He says upside for Boeing relies on sustained positive momentum for production and deliveries, which we believe BA is poised to demonstrate. We'll see, of course, if that actually happens, but Boeing currently higher by about 1.3%. Next, you have American Air getting multiple Wall Street upgrades. TD Cowen, Melius, and Jefferies all upgrading the airline to a buy. TD Cowen in particular says that tailwinds for the company include better domestic pricing, increasing business traffic, and improved credit card economics. And finally, we have Piper Sandler upgrading Band-Aid maker Kenvue to a buy, citing healthier margin trend. The firm says that shares of the consumer health company have appreciated in recent months, but there is still room to better align with peers. You can see shares up about 1.7%. Now, coming up next, Barclays out with a new report on shareholder activism, with 2024 just shy of hitting the record number of campaigns set back in 2018. That's next in our Wall Street Beat. This is Bloomberg.
It's time now for the Wall Street Beat. Barclays out with a report about the rise in activism across Wall Street, and the authors found that over the past 2 years, 20% of activist targets have seen their CEO resign within a year of the campaign initiation, and that's well above the long-term average of 12%. We're going to discuss this with Barclays Global Head of Shareholder Advisory, Jim Rossman. And if you think about last year, the churn in corporate America was drastic. It was stunning, really. And if you now are a company with an activist knocking at your door, is this the number one thing you have to worry about, the CEO keeping their job?
It is a top priority. I've been keeping this data for 10 years. I've never seen a year in which 27 CEOs were dismissed, essentially, because of shareholder activism. And within the S&P 500, what's interesting is that over the years, activism has been a factor in CEO resignations in about 5% of the cases. Last year, it was 15%. So that's 3 times as likely a reason for an S&P 500 CEO to be fired or dismissed based on activism.
We were actually talking about Fannie and Freddie in the last block. You know, Bill Ackman had kind of gone away from activism, and now it seems like he's being drawn back in. Does Trump have anything to do with this, the new administration?
Well, I think what Trump adds is a period of stability. I mean, as odd as that might sound, we now know who we're dealing with for the next 4 years. We know what potentially the antitrust environment is going to look like. And we also have sort of a glimpse into where rate policy might go for the first time in a couple of years. So a lot of the uncertainty was lifted finally by the results of the election. Now we know what's on the table, and now activists can focus on what's going to work in this next 4-year period.
Well, I want to talk a little bit more about that CEO stat, because we've been watching these CEO resignations come in over the past several months. And it's interesting. You point out in your research that in several cases, you think about CVS, you think about Starbucks, that C-suite change came without even an activist on the board necessarily.
I think the 2 words I'm using this year to describe the board's attitude towards management is aggressive and impatient. And if you also look at a couple of the other CEO departures, Stellantis, Intel, you didn't even need an activist, right? The boards took action. And I think that's the result of an impact of shareholder activism over a long period of time.
boards are no longer waiting. They're impatient. They know that their jobs are on the line in a way that didn't exist in the past, particularly with the arrival of the new legislation, the universal proxy, which if there is going to be a fight at the ballot box, it's not going to be slate versus slate. It's going to be director versus director. So I think the boards have changed, a new standard of governance.
Those are also some standout failures, though, right? I mean, Katie, you wanted to do a story on the fall of American icons.
Yes, I still
Surely
do.
Intel is in there, right?
Yeah.
I don't know if Chrysler fits anymore, but Boeing, Starbucks.
And no vocal activists there. And if you pull up, it's interesting to see that tension between boards and CEOs surface. But the types of activists you're seeing, you still have Elliott, of course, being the most feared kind of leader in the board there with 14 campaigns that you have seen them do last year. But then you hear names that are lesser known to many investors: Strategic Capital, Oasis, Irenic Capital Management, 7 campaigns, being one of the top 5 activists last year. Should companies start to fear the fact that more investors are getting into the activism game, because even the ones you may not have known as drastically could be the ones that are ousting you later on?
That's right, Sonali. In fact, I'm starting to think about the entire asset manager community. 160 investors, why even call them hedge fund activists? 160 asset managers decided to use activism as a strategy to force change. That's a broadening out. Why is that happening? Well, if you look at most shareholder bases, who owns 30 or 40%? Index funds and quants. Who's left to do the job? And I think for a long time, traditional shareholders ceded that to activists. What's happening now is a whole new generation of asset managers who in the past might not have adopted this strategy. They're like, well, if we don't do it, we're not going to sit around and wait for Elliott to do it, or Vanguard. Like, why don't we step into the breach?
That's very cool.
Well, you also point out that you had 45 first-time activists, and I just find what you're describing really interesting because you sort of put that against the fact that short sellers have kind of gone underground in a lot of cases, and at the same time, you're seeing a lot of activist investors come out and actually enter this world for the first time. I wonder how you think about those two things.
Well, there's a broad set of targets. Not everyone is a Magnificent Seven, right? Everyone asks me this question. Well, the market's up. Short sellers are hiding. What's the problem? You know, why do we have so many activists? I'm like, well, there's 7 companies that are doing really, really well. There's a Russell 3000 to look at. 65% of companies targeted by activists are actually small and mid-cap companies. So there's plenty of territory for shareholders to look to for activism.
You know, it's interesting. I was thinking about Katie's comment of the fall of the American icon. You also have to wonder if it's also the fall of the American conglomerate. A spin-off index that Katie likes to look at, too, has just absolutely soared over the last couple of years.
Close to record highs.
It's not just companies coming together, right? It's companies falling apart.
Yeah. Well, that's a pendulum thing, right? That happened in 2000.
Right.
And then they all got back together, and then they all get broken apart. That's just money for bankers.
So here's a new factor.
Yeah.
The convergence of private equity and public markets. Many companies now are owned privately. And if you looked at the Apollo September, right, investor report, big question mark over, they're done with going after private debt. The public equity markets are next. I think there's an arrival of the private equity sort of theme of how you manage a company, how you hold CEOs accountable, are coming for the public markets.
This is fascinating stuff. We have to get you back, Jim.
Thanks
so much for joining us. Barclays Global Head of Shareholder Advisory, Jim Rossman, talking to us. I want to quickly mention that Canadian Prime Minister Justin Trudeau is going to quit as the leader of the Liberal Party. He's led for 12 years. He's been Prime Minister for 9 years, and that brings up a new PM race as well. We're going to get a statement from Trudeau out of Ottawa at 10:45, so just about 50 minutes from now, and we'll bring you that live. Coming up in the next hour, the CEO of Chuck E. Cheese is going to join us to talk about this business that has been through twists and turns as well. We'll hear about it from David McKillips in the next hour. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
Coming up, a food processing deal that will keep the chicken wings flowing this Super Bowl. We're going to discuss it with the heads of JBT Marel.
And Chuck E. Cheese, the iconic 80s mouse you love to hate, expanding its entertainment restaurant chain. We'll speak to the company's CEO later this hour.
And Congress is set to certify President-elect Trump's win, barring any peaceful protests. It is January 6th. Meanwhile, Canadian PM Justin Trudeau is set to resign as the leader of his party. We'll have the latest on that as well.
Let's get a check on these markets, though. You can see the S&P 500 now higher by more than 1%. Trading volume, at least compared to the last 20 days, also well above its average. Being led in a big way by big tech, of course, NVIDIA having a great start to the week ahead of CEO Jensen Huang speaking later tonight. The Nasdaq 100 up 1.4%, 1.5% if you're feeling generous at the moment. And then you take a look at the bond market. Another rise when it comes to the 10-year Treasury yield, higher by 2 basis points. We are well above 460 right now, but not really making a dent in the equity market right now, Matt.
We are going to have, by the way, an interview with Jensen Huang. Ed Ludlow is coming out of paternity leave to sit down with the NVIDIA CEO tomorrow. That's one you don't want to miss. The company has been at the forefront of today's rally and Friday's as well. Let's talk about tech leading the way with Nancy Tengler. She is the CEO and CIO at Laffer. Tengler, and she joins us now. Nancy, it looked rough for about 5 days post-Christmas. We had a big slump, and then Friday we came roaring back. Today seems like another good day for tech. Is it the trade of 2025 as well as 24 and 23?
It is. Thanks so much for having me. You know, you've been around a long time like I have, and there's this thing called window dressing that portfolio managers engage in at the end of the year. So you saw a lot of gain and loss taking in the last week. And then add to that the hedge funds and the algos run the market in the very short term. But I would argue that they create the volatility that is the friend of the long-term investor. So pay attention to the companies you want to buy in that environment. If tech doesn't work, because it's going to lead in terms of earnings growth, operating income, and margin growth, the S&P, all other rest of S&P companies by a wide margin. If that doesn't work, the market doesn't work. So I know the naysayers have been saying the tech trade's over, AI's overdone. I don't agree with any of that. We've been overweight since the summer of 2022, and we will continue to be so.
Well, Nancy, I hear what you're saying, but let's talk about the bear case. And one of them, of course, outside of valuations, is just the earnings picture. Really interesting data out on the terminal this morning that if you take a look at the Magnificent Seven, expected to post a combined profit increase of 18%. That's down from 34% in 2024. And if that's actually delivered, that 18% increase, that puts the Magnificent Seven on the same level as healthcare, which hasn't exactly been a darling. I wonder how you thread that needle.
Well, I think there's a difference, Katie, between the Mag 7 and the rest of tech. So I know that the market keys off of the Mag 7. It's just like we still quote the Dow, but nobody really invests according to the Dow. So I think you have to be careful in that regard and pay attention to the companies that are growing earnings in the high double digits. Like, look at a company in our 12 Best Ideas portfolio like ServiceNow. They've been growing earnings in the low 20% range for the last 3 years and are expected to continue to do so in the next couple of years. Or one of our other 12 Best Ideas, Spotify, which is already up a considerable amount after the year of monetization. They're going to grow earnings 58% next year. So there are bright spots that you want to take advantage of. Growth earnings are expected to come in around 16% next year, and value somewhere over 15, and value around 9%. So I want to own the growthier segments of the market in a slowing economic environment, and it looks like that's what we're seeing in Q4. GDP now has been revised down from 3.2% growth to 2.4%. So you want to own the reliable growers, and those still exist in technology.
Speaking of technology, it's interesting that you're looking to plays outside of the big AI companies, the big tech companies out there. You named Spotify. I know you're also keeping an eye on Walmart as well in terms of how it's affected by AI and technology. How do you think about the potential there? What are the other names you are looking at, particularly for investors who are looking to buy something a little cheaper than NVIDIA is right now?
That's a great question, Sonali. So look at a company like Uber that's using generative AI for their dynamic pricing model. It's an industrial, though we think about it as a tech name. Or think about a company like American Express that is using generative AI to increase fraud detection. Or one of our other 12 best ideas, Goldman Sachs, that is using generative AI to replace some basic functions that they got from analysts, young analysts. That you can go across the sectors in the S&P and find use cases. Healthcare, another area that's using AI to improve product development and productivity. And what we saw in the Bernstein CIO survey, Sonali, was that while over 80% of CIOs think that large language models are super important, only 8% are allocating a portion of their budgets, a significant portion. So there's plenty of spend still to come. Bill McDermott at ServiceNow said he expects $20 trillion by 2030. You heard what Hock Tan said, another 60 to 90 billion in AI spending from existing customers by 2027. So there's a lot of spending that will continue because the productivity enhancements are there and companies are experiencing. Walmart is the poster child.
I'm looking at your call on American Express. It strikes me that a lot of large corporations have moved away from American Express, as a corporate card for employees. On the other hand, the stock has absolutely crushed MasterCard and Visa. If you look at the comp chart, American Express is up 145%, Visa and MasterCard each less than 75%. What is the secret sauce for this company? Why do you like it over its rivals?
Yeah, well, so they're appealing to the millennials, and the millennial growth has been explosive in new card ads. And so they have figured out how to appeal to them. Both my millennials have American Express Platinum cards. I don't know that they can afford them, but they want them because of all the free things that you get as a Platinum card member, So I think they've done a really good job. It comes down to marketing and brand. And American Express has it in spades. So we've owned it for a long time, and we will continue to own it as one of our largest holdings in our growth portfolios.
And Nancy, we always enjoy talking to you because you come with specific picks and you invest in your best ideas. You have this best ideas portfolio. And this is a question I've asked you before, but when you take a look at your list of best ideas, which changes periodically, I'm sure, what is the common denominator right now? What is the common thread that you can draw from these 12 names?
Yeah, so it's great management teams, Katie. You and I have talked about the optimal diversification historically has been 12. Most portfolio managers don't have the conviction to own 12 names. We do. It has served our clients well because the strategy is since inception, and I've run it multiple times in my career, but the most recent inception was 9/1/2019, and it's up an annualized 16.85% during that period. So it always outperforms our other strategies because we're buying the best companies with brand, with great management teams that have pivoted or have the ability to pivot as things change. So think about Palo Alto Networks, moving towards platformization in the cyberspace. Or think about Uber, which is also a member, Spotify, even Microsoft. And by the way, they don't all work every year. Home Depot lagged for a number of years, and it outperformed last year. Goldman Sachs had a brilliant year last year. We think it will continue to, but it may lag for a period of time. And so not all of the names are working all the time. But we do think that these represent, in our view, from a valuation, fundamental, and management standpoint, and management is key, they represent the best companies of all the companies that we own.
Nancy, some of the stocks that are in your top picks, Walmart, American Express, are also levered to the U.S. consumer, albeit in some cases a wealthier consumer. You think about American Express, but how much do you consider issues with consumer spending that could arise this year when you're thinking about those picks?
No, that's a perfect question. I mean, what we started to hear some rumblings that charge-offs are up and consumers slowed down in the fourth quarter. But there are a couple of things that most investors are not paying attention to. First of all, they've delevered the U.S. consumer. So we're back to levels that we saw pre-2008. So relatively low levels of leverage on their balance sheets. The collective net worth of the U.S. consumer is somewhere around 170 billion. Yes, about half of that is the baby boomer generation, but they're spending, and so that continues to provide support. It's the low income cohort that we continue to worry about. That would normally affect Walmart, but because the high end consumer has moved down into Walmart stores, I think I've said this on your air before, but my Walmart in Scottsdale has Veuve Clicquot and all sorts of very expensive liquor under lock and key. So they have upgraded their offering. They've cleaned up the stores using robotics and improved the associates' job experience by adding AI to many of the functions that were tedious and not interesting, and therefore, not productive.
We should do a class trip.
So we think they continue to outperform. Sorry, Matt.
We should Nancy, we're going to bring the whole open interest staff down to the Walmart in Scottsdale just to check it out for a long weekend. Nancy, great having you on the program as usual. Thanks so much for joining us. Always great to get your take and especially a look at some of these individual stocks. Nancy Tengler there of Laffer Tengler, where she is CEO and CIO. Coming up, JBT Marel ringing the opening bell at the New York Stock Exchange after finalizing a takeover deal. We're going to speak with the leaders of the food processing company next. This is Bloomberg. Let's get now to high interest. Look what's making headlines around the world. Canadian Prime Minister Justin Trudeau is expected to announce his resignation as leader of the Liberal Party later this hour in Ottawa. Trudeau has been under pressure from lawmakers and his party to quit for months. Calls for his resignation increased after Chrystia Freeland, his finance minister, resigned last month. An official says Trudeau still stays on as prime minister until a replacement is found. Now, the snow here in the U.S. is piling up. In Washington, D.C., with forecasts for up to 12 inches in some areas, the winter storm is shutting down federal offices and schools as it makes its way east. It's the first major snow event across most of the central and eastern U.S., dropping as much as 18 inches across eastern Kansas. Over 1,300 flights in the U.S. have been canceled, but hopefully Congress is still going to be able to confirm the election results. It is January 6th. The Brutalist and Emilia Perez were the big winners at last night's Golden Globes after taking home the Best Picture awards for drama and comedy. The Brutalist star Adrian Brody also winning Best Actor, and Brazilian actress Fernanda Torres winning Best Actress for her role in I'm Still Here. In the TV awards, FX's Shogun cleaned up, winning Best Lead and Supporting Actor, Best Actress, and Best Series. Sonali?
Excited to watch it. We are going to switch gears, though. We are going to talk about a recent merger. JBT has completed its takeover of Marel. The combined company is hoping to create a global leader in food and beverage technology processing. It started trading under a new ticker last week and rang the opening bell at the New York Stock Exchange today. Joining us now from the Stock Exchange are Brian Deck, JBT Marel CEO, and Arni Sigurdsson, JBT Marel President. Very interesting deal to both of you. Brian, you recently told investors that what you're targeting is a multi-trillion-dollar end market. Ultimately, how does the scale that the both of you have help you meet that end market relative to your rivals better?
Yes, thank you for having us today. So we're very excited about the combination. This really does bring two traditional heavyweights within the food technology processing industry. But we are very complementary to one another, serving common customers. So when you think about bringing us together we will be in the range of about $3.5 billion of revenue, which would make us the largest or the near largest player in the food technology space. So, and when you think about what we bring together to one another, we've got complementary technology to support our customers, both on the core technology, the service, the software, all the things that are necessary to help our customers be more successful in what is a competitive food environment.
And Arni, I want to talk about what this means for Marel and for you, of course, your business headquartered in Iceland. Will you move to the States, or how does that integration look going forward?
Yeah, no, thanks for having us. What this means for Marel is really the opportunity to live our vision. And our vision is around transforming the future of food. And we are a global business. With our business, we have a strong presence in North America. We will also have a strong presence in Europe. We're doubling our size in Asia Pacific and also in Latin America. So we're truly a global business. So we'll need to be a lot on the road. So it's not really about whether it's in Europe or in North America. It's really where the consumer is and where our customers are.
And Brian, I am curious about what this acquisition gives you that you couldn't have done organically. I mean, I'm thinking about Marel. It has a presence in pet food, for example. Why go this route, sort of the inorganic route, versus creating some of this on your own?
Right, so there's some tremendous technology that Marel has that JBT does not have. It really brings a tremendous depth within the poultry, the pork, the fish industry that JBT does not serve comprehensively today. So offering that fuller line solutions to our customers. So when you think about a piece of food coming in as a commodity and then ultimately coming off as a packaged product, it's quite important for our customers to be able to do this ideally with one vendor, having fuller line solutions, full service, full software, all the things that make them successful without having the disruptions in multiple vendors, and having that partnership together is really unique, and in particular the technology that Marel brings that JBT does not have today.
Brian, it's interesting for you to look across the pond here to make an acquisition, to think about a global brand at a time where the world is trying to separate itself, to unlink a lot of that globalization that has really taken off over the last couple of decades. How do you think about the threat of President-elect Trump's tariff policies and what it could mean for demand outside of the United States as well as within it?
Mm-hmm. Well, first and foremost, I would say food is a wonderful, amazing industry to be in. And so everyone has to eat. We have a presence throughout the globe. We've got about 50 locations globally, collectively between the two companies. And for the most part, we serve regional businesses from our regional operations. We do some importing. But in general, when you think about food, food is the one area that has the most staying power, has the most consistent growth and an opportunity to provide some value for our customers. So regardless of where we think the political environment looks, we feel that we're extraordinarily well positioned given the new scale that we'll have, given the technology, the breadth of our service, the breadth of our offering. So we're quite excited regardless of the environment that we're going to be working in.
And Brian, I'm curious to get your perspective on avian flu. We usually think about it and monitor it through the lens of egg prices and whether they go up or down. What does the bird flu mean for your business, and what is the current state of affairs there?
As it relates to pricing for food, so when you think about pricing for food and the impact on the consumer, I think one of the most important things in the role that we can play is helping our customers lower their cost of conversion. So obviously you've got the commodity costs associated with food, but where JBT Marel comes into play is lowering those costs from the water usage, electricity usage, more uptime on the equipment, better food yield. All those things require a tremendous amount of technology, which is what we bring. And so by supporting our customers on their cost side, it certainly helps on the overall food inflation environment.
What we also have an opportunity to do with the fuller lines that Brian talked about is that we can help our customers to become more demand oriented, to really understand what's happening with the consumer, what's happening in the retail stores, to really be able to fulfill that demand, because there's a lot of global food waste, and around a third of food is wasted across the value chain. So with fuller lines, software and traceability across the value chain, we can really partner with our customers to really help on that journey, which should eventually help also with the pricing with the end consumer.
All right, well, it's great to get some perspective from you guys, and congratulations, of course. That is Brian Deck and Arni Sigurdsson of JBT Marel. And also in the food industry, we do have some IPO news, Sonali. This from top pork producer Smithfield filing for a U.S. IPO.
Yeah, speaking of the food market, it is interesting to see how many food-related companies we have seen come to the show since the show started. I would say not only do they have $14 billion in revenue through the 12 months through September, they're also profitable. And so you're seeing profitable companies come to the IPO market, giving investors something to chew on in this IPO return.
Yeah, it's not 2021 anymore. You have to be profitable if you want to IPO. In any case, still ahead, Disney is taking on YouTube as it plans to combine its Hulu Plus live TV business with Fubo TV. We'll bring you the details on the tie-up next. This is Bloomberg. All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Amazon will release a Melania Trump documentary later this year that will hit theaters and stream on its Prime subscription service. Mrs. Trump is an executive producer on the film that is being billed as a behind-the-scenes look at her life. Filming for the documentary began last month after Donald Trump won the U.S. election. Next up, Getty Images exploring a combination with its rival Shutterstock. A potential deal would bring together two of the biggest providers of licensed visual content in the U.S. This news comes just as demand for pictures, videos, and other media soars as consumers spend more time online. Both Getty and Shutterstock aren't commenting. And finally, staying in the streaming space, Walt Disney and streaming provider Fubo TV will combine their online TV businesses. As part of its deal, Disney will fold its Hulu Plus live TV business into Fubo, creating a new venture that will be 70% owned by Disney and the rest by Fubo. The services would create the second biggest digital pay TV provider, trailing only YouTube TV. You can see Fubo shares absolutely skyrocketing right now, up 136%. I didn't realize, but on Friday, Fubo closed below $500 million in market cap, so a big coup there. Coming up, we'll speak with the CEO of Chuck E. Cheese. Don't go anywhere. This is Bloomberg. Well, after filing for bankruptcy 4 years ago, CEC Entertainment is back to having some fun. The parent company of Chuck E. Cheese is modernizing thanks to a $350 million investment. Those enhancements include a new playground concept, an improved food menu, and international expansion as well. Joining us now, I'm pleased to say, we have David McKillips. He is CEC Entertainment President and CEO, joining us on set. It's great to see you in person.
Great to be here as well.
So we were just talking in the commercial break that Chuck E. Cheese, and we all have memories at Chuck E. Cheese's, it's been around for 47 years.
That's right.
How do you stay relevant in 2025?
Well, we're really celebrating a brand transformation that is just completing this quarter. We've invested close to $350 million reimagining the entire Chuck E. Cheese brand. So we have remodeled not only the facade, but as soon as you walk in through the front door, every single element of Chuck E. Cheese has now been upgraded. It's a digital experience. Kids are now consuming entertainment much differently than they did years ago. So we replaced the animatronics with a full digital experience, floor-to-ceiling jumbotrons, digital dance floors, small trampolines. We've got adventure zones. We've got a television network, new games. It's really a whole new experience.
Animatronics, for those who are too young to know what that is.
I remember.
There used to be a band, like at Stu Leonard's, they had this moving animals.
Which is still a draw for me.
There aren't any, except for at one store in California, right?
We actually have one in each region of the country. So we've got it in the West Coast, the Midwest, and the East Coast, and then here in the Northeast, Nyack still has one of the original.
So you had, before you came on board, there was a string of problems. You had a SPAC sale that then didn't go through, and like a month after you came on as CEO, we had COVID, and then lockdown obviously is horrible for a business like Chuck E. Cheese. You did turn it around in a sense with pizza deliveries, and then I think it was Pied Piper Pizzas, which was a brand, and also you named another pizza service after one of the members of the band, Pasquale.
Which people didn't necessarily know was Chuck E. Cheese.
But exactly. But now you've done so well under your leadership that a lot of people are talking about coming back to the public markets again. Is that part of your plan? Do you want to IPO this company?
We're not quite there yet. We're still, along the transformation. We are just completing this investment, and we've launched, if you look at, the 3 out of the 4 Ps, right? Your product, we fixed the product. Chuck E. Cheese is all new everywhere you go across the country. We're expanding internationally. The second is price. And with the value-conscious consumer, especially young households that we cater to, we have to be sensitive, and we had to price ourselves. We introduced a 2-month pass where we sold 400,000 summer passes this summer, and then introduced a 12-month membership. 3 tiers. The entry point is just $7.99 per month. That's unlimited play every single day for 40 points a day. And you get discounts off F&B as well. So we need to see that strategy out. It's working for us. The last 8 out of 9 months, we have had positive same-store sales, which is really, ducking the competitive set right now.
Speaking of the competitive set, it's interesting because there was a Reuters report at the end of last year that spoke to your future potential options here, and the numbers were really interesting in it. This idea that you were expected to generate more than $1 billion in revenue. Did you hit that mark? Do you see yourself needing to hit other targets before you get to that strategic option,
for our fiscal
whether
year,
sale or not?
For our fiscal year 2023, we're just north of $900 million in total revenue. Very attractive four-wall margins, about 28%. But again, it was about setting a new sales strategy for us. So we had to fix the product. Now we've got the pricing in. We have over 100,000 memberships sold in the first quarter of selling the members. And these, and I'll take you through the math a little bit. The average family will come and spend roughly about $45 to $50 with us. Okay? The 2-month member is worth 2.5 times that. And then the 12-month member is 6 to 8 times that value. But it takes a full 12 months to see the full value of that. And we're seeing that now. And that's why our traffic is up, and that's why our same-store sales have enjoyed positive results in 2024.
I want to talk a bit more about the experience of being at Chuck E. Cheese's from the parents' perspective.
Sure.
And I don't have kids yet, and you won't let me bring my cat, which makes sense. But do you focus on whether parents enjoy the trip there too, or are you just solely focused on the children?
So our focus is on our greatest customer, which is a 5-year-old. Right? We cater to a 2 to 12-year-old, bullseye 5, 6, 7-year-old. Right? We look at everything that we do, from our games to our food to our entertainment, through the eyes of a 5-year-old. Right? We're safe, wholesome family entertainment. We have now shifted on the third P, promotion. We have now shifted our advertising strategy to go back and really target against kids. So you'll find us in front of the kids' movies in the theaters. You'll find us all over, the kids' shows, on whether it's streaming or on the network, on linear television. So we go directly after kids, and kids will ask their parents to come to Chuck E. Cheese. But what sets us apart, it's about participatory play. We were just talking right now about playing skee ball. You play with your kids, and the number one, our number one driver of guest satisfaction for parents is to see their kids happy.
So it sounds, though, like I'm not going to be able to get a beer there.
You can get a beer, you can get a wine, you can get a cooler if you'd like.
All Katie cares about.
That's not really a big part of our business.
She was like, "Can we get booze there? Is it possible?" I play air hockey with my daughter.
Excellent.
Full disclosure, she absolutely loves it. And you've really crushed it as CEO. You have a fascinating career path because you worked at DC Comics, SeaWorld, and then Six Flags, where you maybe really cut your teeth. What would you say is your biggest strength in preparing you for this role? How did you learn the ropes in order to turn this business around?
I've had the opportunity to work in operational departments, in licensing, in capital light, in heavy CapEx departments. Warner Brothers DC Comics was such an incredible training ground for me to really understand the power of the intellectual property. And then when I got the call about the gig in 2019, I walked into Chuck E. Cheese, and the countdown was happening, 5, 4, 3, 2, and then Chucky comes out, and the kids are losing their minds, like a Taylor Swift concert for little kids, right? It was spectacular. I knew the power of this intellectual property was so strong. We just had to clean up the 4 walls, and now the next step for us is to go beyond those 4 walls.
Yeah, as a woman whose dog's name is Loki, I totally appreciate, maybe not the DC world, but that's for another showdown. I want to talk about the consumer, the American consumer, because so much of your business, and you worked with entertainment for a long time. How resilient do you think they will be this year, or do you even have concerns that some of that optimism could fade?
So I've heard some great comments. One is selective recession, right? There's a bifurcation in the economy. There is absolutely no doubt. If you go back 6 months ago, and we do monthly brand insight tracking constantly, we look at families with kids 3 to 9 years old, okay? And we do that every single month across the nation. In May, more than 70% of households, whether 50,000 household income or 100,000, had concerns on food pricing, on gas, just on inflationary costs. Fast forward 6 months into December, that $50,000 household income is still having those same concerns, close to 80% worried about food costs, gas, utilities, and just all inflationary costs. Whereas now we're starting to see those families making $100,000 or more, you're starting to see the concern drop a little bit. The latest in research that we had said about 53%. So that dropped from 70% down to 50%. But those that we cater to are lower on the household income, not because not because of their earnings on an annual basis, just that they're younger in their earnings potential, right? These are young families that are just starting out in their apartments or condos or first-time homes. So we're in that 50 to 60,000 range, and they're still concerned about value.
Absolutely fascinating. We talked about this in terms of Walmart getting a lot of their numbers really rising $100,000 or more, but that's 85% of the U.S. population is still below that $100,000 mark, Katie.
Yeah, it's interesting, though. It seems like people are still willing to pay for experiences. And obviously, if you're going to Chuck E. Cheese, you're going to have an experience. And before we let you go, we don't have a ton of time left, but I want to meditate on the fact that you took over January 21st, 2020. You said you got the call in 2019. Obviously, I don't think you predicted that we would have a pandemic coming and we would all spend, a year at home. There were a lot of businesses, experience-based businesses, that just went out of business in those times. I mean, how tenuous was that moment when you look back at it? It
was incredible. 6 weeks later, we closed the doors for COVID. 4 months later, we had to file for a debt restructuring in Chapter 11. I did that at Six Flags as well with a different management team. So I kind of knew the playbook. But the bones of this company have always been strong. We just didn't have the balance sheet. And there was no way we were going to survive without being open. And even though we're the 10th largest pizza company in the world, we're not in the business of selling pizza. We're in the business of selling entertainment. And so that's why we've had to switch our business model. We're going to bite-sized investment from our consumers. We're trading discounts for multi-visitation. The membership is paying off. It's working for us. But those who are going to survive and flourish in this economy have got to deliver value.
David, we thank you so much for joining us here on set to kick off the year. That is David McKillips of CEC Entertainment. Now, guys, while we've been sitting here for the last couple of hours, been watching Bitcoin barrel not only above that $100,000 level, it is getting closer to $102,000 already per Bitcoin. And you take a look at that move. It's interesting to watch it. Also want to discuss MicroStrategy because it's on its 9th consecutive week of purchases. Just announced. What I wonder is when you have 9 weeks in a row, and if you don't buy on the 10th, then what happens to Bitcoin?
Well, we know more is coming. I mean, we interviewed Michael Saylor a couple of weeks ago. They announced those plans in October, $42 billion. We know that the mix that they're raising is going to shift away from equity and more towards convertibles. So interesting to watch there. And we all need to care about MicroStrategy, even if you're not a Bitcoin person. It's in the NASDAQ 100. You have a lot of passive linked assets now exposed to MicroStrategy and to Bitcoin.
Your interview with him, the interview that we did on this program a couple weeks ago, really foreshadowed what he would do with that power, that NASDAQ 100 power. They've said on Friday that they plan to raise $2 billion through perpetual preferred stock offerings. So away from that debt-like feeling to more equity-like capital raise, and they can do it with that power.
Well, even the convertibles, I mean, they're trading a lot of them as equity. You know that you can convert the debt into equity, and they're through the strike prices on a lot of them. Matt, any comments?
I'm just going to back up here.
Come on,
please continue.
Come in, let's talk about capital structure a little more, Matt. We like it when you get nerdy.
But coming up.
Yeah. I mean, look, it's a risk-on session, and Bitcoin moves with that kind of risk appetite. Coming up, we're going to give you a story about Tengler. Bank America Chairman and CEO Brian Moynihan discusses his 15 years leading the financial institution through the financial crisis to now. This is Bloomberg.
All right, it's time now for our daily Wall Street Week conversation. And on January 1st, 2010, Brian Moynihan took over as CEO of Bank of America, which had just gone through a series of mergers. David Weston spoke to Moynihan about how he turned the bank around following the Great Recession.
I knew I had to be here a substantial time to work with the team and drive the company to what it could be, and that's great. But it never was like to do this job 5 years. I think the time has to be where you have the place from where we were in a place that's great condition, and there's still a lot ahead of us that we can do better on and make good things. So I never really thought, I was 50 years old, I would have never thought that there was a time frame on it. I never was going to work anywhere else. I always wanted to work here and drive this company, so I never contemplated an endpoint.
You have a lot ahead of you. You also have a lot behind you. And when we think about what the banking world was, what Bank of America was in 2008, 2009, going into 2010 when you took the job, it was a different world. Explain what you faced when you came in. 2008, 2009, as you worked your way up and then ultimately got the job in 2010.
Well, so a lot of people don't remember that in 2007 and 2006 is actually where the financial crisis started to come through. The property value started going down, the overlending on the consumer side became exposed, the ripple effect through some of the CDOs and things like that, the impact on the Bear Stearns and Lehman and Marel and other companies and the acquisitions that took place in 2008. And so you had but people, when you look back, what you had was non-banks that weren't governed by any rules, that were all brought in the banking system, and the net was thrown over, the tent was thrown over a lot bigger group. That's what made it different coming out the other side, because suddenly the group of my peers were Goldman Sachs, Morgan Stanley, JP, Citi, ourselves, et cetera. It wasn't just the banks and then the securities firms over here or the insurance firms over here, and that changed dramatically. And then the rule set became applicable to everybody. And so, and then we acquired Marel and done a lot of deals which changed our constitution as a company. But that's the biggest change, is suddenly you had an industry which was much more holistically, and everybody was in the tent. And that then required all the rules to change fast and all the reach to change fast, and stuff people hadn't thought about. The Volcker Amendment and this stuff, stuff that people hadn't thought about. And that was because suddenly you took all these people who were governed by different regimes, different rules, threw them in a pot and said, we're going to put a tent over all of them.
If there had never been a great financial crisis, there was a lot of change going on within Bank of America. As you mentioned, Merrill Lynch, you had countrywide, you had various things going on. How did you set priorities in 2010 with the world changing around you and your own company having gone through a lot of change?
I think Rahm Emanuel's quoted saying, never let a good crisis go to waste. But, we had done from 2003 fall to 2009, January 1st. We'd done Fleet Boston, MBNA, Countrywide, U.S. Trust, Marel, and I'm missing somebody, LaSalle. And all those companies have come together, and all those employees have come into the company. And those employees represented more employees than we had. So it was this huge cultural put together that went on. But what you had in the base of that was these 8 lines of business we talked about. You had that when Jack Welch or somebody say you got to be top 1, 2, 3 in the business. We were top 1, 2, 3 in all the businesses across the 8 lines of business. But what we had is a lot of other stuff that was not as interesting.
And that was Brian Moynihan speaking with David Weston. You can catch Wall Street Week every Friday at 6 p.m. Eastern. Meanwhile, Canadian Prime Minister Justin Trudeau expected to speak any moment after the announcement that he plans to quit as his party's leader. We'll bring you that as soon as it happens. This is Bloomberg.
Canadian Prime Minister Justin Trudeau is set to resign as the leader of Canada's Liberal Party. He's expected to address the media at any moment. That's why we're showing you this shot of, I guess, his house with the empty podium in front of it.
It snows in Canada. Who knew?
It snows all the time up there. But it'll be interesting to see what impact it has on U.S. politics, if any at all. Balance of Power co-host Callie Lines is in early, and she joins us now. Callie, I guess this is fascinating in that it unraveled over the last couple of months with a dispute with Chrystia Freeland, and her resignation letter basically damned him as leader of the party. What effect will it have on U.S.-Canada relations as Trump comes in with the intention of putting on tariffs?
Well, that's exactly the thing here, Matt. Even if Trudeau does resign today, triggering a new election essentially for who will be prime minister, whoever comes next is going to inherit this very difficult relationship, it looks to be, between the U.S. and Canada as Donald Trump gets set to take the oath of office 2 weeks from today. Remember, Trudeau has been under pressure for months. That has intensified, as you alluded to, Matt, in recent weeks since the December 16th resignation of Chrystia Freeland. And that was really due to a policy dispute. She had issues with the fiscal trajectory being outlined by the Trudeau government. government, considering the potential looming trade war that she feared if Trump implements the tariffs he has talked about, because he has threatened putting in place 25% tariffs on all Canadian goods if Canada doesn't act to stop the flow of people and illegal drugs over the northern border in a way that Trump sees fit. Granted, there has been a lot of talk here in Washington about that just being a negotiating tactic, not necessarily something Trump would immediately try to implement, but nonetheless, it does underscore the pressure the Canadian government has been under to try to find a way to normalize the relationship with Donald Trump in advance. That's why Justin Trudeau actually made a trip to Mar-a-Lago late last year to talk with Donald Trump. That resulted in, we understand, Trump joking at the table down there in Florida that Canada should just become the 51st state and refer to Justin Trudeau as Governor Trudeau, something he doubled down on later on social media. So clearly there was some contention in the relationship Trudeau had with Donald Trump, and assuming Trudeau does indeed follow through with the expectation here, which is a resignation today, it will be something that the next person has to deal with as well.
I also, Callie, want to bring matters back here to what's happening in the United States, because, of course, it's January 6th. You're looking at the vote certification. You're also looking at, the aftermath of Mike Johnson's scuffle, let's call it, with certain members of the House. All in all, what does this mean about how the nation is expected to govern? On the issue of January 6th alone, of course, there's that looming question of pardons.
Yeah, that's absolutely right, Sonali. Donald Trump has promised mass pardons for those who have been convicted for what happened 4 years ago at the Capitol on January 6, 2021. There's been more than 1,000 convictions, and it's not quite clear if it will be all offenders, nonviolent offenders only, or how exactly the incoming president plans to deal with it. That said, this January 6th in 2024 is expected to look very different, not with the same violence the country experienced 4 years ago, in part because there is no one inside or outside the Capitol who is contesting the results of this election. Kamala Harris, who lost the presidential race to Donald Trump, will be presiding over these proceedings today with a joint session of Congress. It will begin at 1 p.m. Eastern time. They will certify the victory with more than 300 electoral college votes that Donald Trump received at the election in November. So it's a very critical part, of course, of the peaceful transfer of power in the U.S. Again, not the same as what we experienced 4 years ago, but other than a lot of snow on the ground here in Washington today, that may make it a little trickier for some of those trying to get to the Capitol to do so. It is expected to go pretty smoothly.
Callie, we have about a minute left with you. I want to talk about some comments that Mike Johnson made after winning, of course, that speakership in the first round, which I think was surprising to some. He said that he plans to pass Trump's legislative agenda by May, of course. We're talking about the House here. What are they going to prioritize? And does that differ at all from what the Senate is going to prioritize?
Yeah, this is where it gets tricky, Katie, because the Senate wanted two bills rather than one big, beautiful bill that Mike Johnson and Donald Trump are now talking about, in which they're going to try to address basically everything in his legislative agenda: energy policy, border policy, and then, of course, tax reform through a budget reconciliation package. It's going to be difficult to wrangle it through the House, as we saw with that speaker vote. Nothing is easy when the majority is this thin. But in the Senate, where there is a nonpartisan parliamentarian that's going to dictate whether or not all of these things actually do apply to budget and revenue matters of the United States, Senator John Thune has said they are not going to try to override the parliamentarian on that by trying to get around through other procedural means anything that they say could not be part of this budget reconciliation process. So it's likely to get pretty testy, and it's going to take some time to actually get that legislation drafted. Hence the late spring timeline that Mike Johnson is talking about here could take it outside of Trump's first 100 days in office.
Well, it'll give us plenty to talk about. Of course, our thanks to Bloomberg's Callie Lines. Meanwhile, we take a look at these markets right now. The S&P 500 extending gains, up 1.2% at the moment. You can thank NVIDIA for that. NVIDIA shares currently up 5%. That is your biggest points contributor to the S&P 500, the NASDAQ 100 as well. Big tech in charge. All comes down to Jensen Huang.
Yeah, and we will have an interview with Jensen Huang tomorrow. Ed Ludlow coming out of his mini retirement to do that interview. It's one you don't want to miss. Obviously, NVIDIA has been powering this rival. Also tomorrow, Gargi Chowdhury from BlackRock, former Bridgewater chief investment strategist Rebecca Patterson, and Jan Hatzius.